Today we zoom out on the S&P 500 to give you our big picture Elliott Wave count, as well as our grim prediction for the future. This is Invest with Jacob. Okay guys, so today's video is a zoomed out look at the S&P 500, basically in three segments. The first thing we're going to talk about is some Elliott Wave basics that you just need to know in order to understand what I'm talking about when we get to the chart. The second part will be covering the chart all the way from the beginning of the S&P 500 until now. And then the third part of this video will be where we are now and where we expect to go in the future. Now we'll get into that in just 1 second, but first, if you're new here, welcome to the show, guys. My name is Jacob Gabbard, and this is Invest with Jacob, and I highly encourage you to hit that subscribe button down below so that you can get our daily S&P updates, our trade setups, and our buy alerts. Okay, guys, so first things first, we have to cover a few Elliott Wave basics so that you understand what I'm talking about when we get to the chart. All right, the first thing is that Elliott Wave, in its most basic form, has two wave patterns. It has an impulsive wave, which is a 5-wave move on trend with the market. For instance, in a bull market, it would go up, and in a bear market, it would go down. Okay? And then you have corrective waves, and those are 3-wave moves against market trend. So in a bull market, corrective waves go down, and in a bear market, corrective waves go up. Understanding the two wave patterns are important when we get into the chart. Now, the second thing to understand is that in an impulsive wave, waves 1, 3, and 5 are fractal. And I'm going to show you an example of this before we jump into the chart, but just know that they break down into smaller versions of themselves. So in order to see these things more clearly, let's jump into a chart where I can draw these waves for you and you can see how they look. Okay guys, so here we are on just a blank chart here, and this is where I'm going to show you what an impulsive wave looks like as well as a corrective wave. Okay, so an impulsive wave is a 5-wave move, okay, that moves up in wave 1 in a bull market. Remember, they're on trend. Moves down in a corrective wave in wave 2, moves up in wave 3, moves down in wave 4, and then moves up in wave 5. Okay, so you can imagine the stock market with all its little candles going up, having a pullback, going up, having a pullback, and going up. So this is what an impulsive wave looks like. Now, it takes on many different forms because nothing moves in a straight line, but this is just the idea. So that's what an impulsive wave looks like. Now, a corrective wave is just a 3-wave move in the opposite direction. So the A wave would be down, the B wave would be up, and the C wave would be down. Okay? So this is, for instance, from wave 1 to 2 would take on this shape where you have a down move, then you have like a bull trap is what they usually call this, a bull trap for B, and then another bigger move down that completes the correction. Okay, so like wave 2 and wave 4 are corrective, so they would take on this shape. They would be a 3-wave move. Okay? And then at the end of wave 5, you also have this 3-wave move. So how a real market move looks is you get 5 waves up, and then from the top of wave 5, you would get your first move down, a little bull trap, and then your final corrective move down. Okay? So it's A, B, C down, and then you would start this pattern all over again with wave 1 up, wave 2, wave 3, wave 4, and then wave 5 up to make a new high over this wave here. All right, so that's what impulsive and corrective waves look like. Now, when I say that they are a fractal, let's get these off of here so you can see. What that means is waves 1, okay, 3, and 5 break down into smaller versions of themselves. And what that means is when we go in here and get our waves, what that means is that, for instance, from the start of wave 1, there will be a smaller wave 1 that starts up here, and then a wave 2 that pulls back, and then a smaller wave 3, and then a wave 4, and then a wave 5 that completes this wave 1. So these 5 waves make up this 1 wave. And then the same thing happens in wave 3. There's a wave 1 up, a wave 2 back, a wave 3 up, a wave 4 back, and then these 5 waves complete wave 3, right? So here's wave 1 that's made up by these 5 smaller waves. Then you would have an ABC correction like we drew up here. Okay? Then wave 3 comes up and it's made up of 5 smaller waves. All right? Same thing goes for wave 5, made up of 5 smaller waves, right? Wave 1 comes up, 2 down, 3 up, 4 down, and then 5 up to make 5. Now, I'm not going to drill down too far because it gets pretty complex at that point, but this keeps going basically into infinity. This number 5 here, this number 3 here, and this number 1 here, they all break down into 5 subwaves. So this is how Elliott Wave gets so complex so fast. That's just the basic element of Elliott Wave, okay? You have an impulse wave up of 5 waves. And then you have a 3-wave correction down, as we saw before. Okay, so you get up to wave 5, and then you get A, B, C down, and then you start the process all over again with a 5-wave move up, okay? And so on. And then there'd be a correction from here down, and so on. So that's what we're looking at, and that's what we're looking for when we get into the big picture chart. All right, so that is the basics of Elliott Wave that you need to understand before we jump into the chart. So let's go ahead and move over to the S&P 500 now, so that it makes a little more sense when you see it on the chart. Okay, guys, so here we are on the big picture S&P count from the very beginning of the stock market up until today. So what you see on here is a bunch of numbers and letters and different colors. So what we want to talk about first is degrees. The largest degree count is the black count that's bracketed. So this 3, 5, 4 Roman numeral that's bracketed, 1 and 2 down here. These are the largest degree count, meaning they're the biggest count. Okay. The next step down from those is the blue count, so it's 1 degree lower. All right. And you can see those. We got a couple different patterns of those. And then the next degree down is the red count, that's the circled numbers. So what we did to start is we need a low to start with on the market. And when the market opened, it came down and made a very good low right here in October of 77. It came up in a 5-wave structure, and that gave us our very first wave 1. Okay. Came back down here in wave 2, came up here in wave 3, then wave 4 down here at this low, and then wave 5 was the top of the roaring 20s. Now, you need 5 waves as a subset to make a bigger wave 1, right? So here's our first grand supercycle wave 1. All right, and all of these smaller degree waves made that wave 1. So here's our 5 waves. Up in 1, down in 2, up in 3, down in 4, up in 5. All right, and the bottom of the Great Depression is our wave 2 pullback of the grand supercycle. Then we need 5 blue waves to take us up in wave 3. Now here's the cool part. We haven't even completed this wave 3. That's what we're trying to do right now. So as you can see, we got wave 1 up right here at the top. We pulled back in wave 2 right here of blue, a blue wave 2. And then we got to count 5 waves up to get wave 3 of blue. So that's what the next degree down red count is. So we got wave 1 up, 2, 3 up here, 4 down, and then 5 up, which was the dot-com bubble of 2000. All right, and then this is a really cool place. Because we're zoomed out so far, it's hard to see some of these ABC corrections, but you can see it pretty clearly here. You got A down, B up, and then C down was the 08-09 crash. And then from there, we've started building our 5 waves up in 5. Because we got 4 down right there. This is the bottom of blue 4. And we've started building this last 5 waves up. So when I say we're in wave 5, I actually mean that in 2 different ways. We're in blue wave 5, okay? And we're also in red wave 5, all right? So just understand that we're in 2 different wave 5s that both end at the same place. So we got wave 1 up off of the 09 low. We got wave 2 down. Wave 3 completed right before March of 2020. And then we got the COVID crash that took us down in red wave 4 right here. Okay, and now we're building this wave 5 up. We're also building this wave 5 blue up from this wave 4, right? Because 5 waves completes this, which also completes this. We are targeting about 6,000 for this wave 5, and wave 3 target. They all target the same place. So once we complete this cycle here and complete this grand supercycle wave 3, we are expecting a severe crash. And that is our grim prediction. In the next 2 to 3 years, I'm thinking closer to 2 years, we should hit this target of about 6,000. And once we do, the ABC pullback here should target around 1,500, or a 75% decline in the value of the S&P. It will be a long, drawn-out bear market, and it will be rough. That is something I'm trying to prepare for. It's why I do this channel, to help people make money, to give them awareness of when to try to protect their assets, because we have not had a grand supercycle hit in almost 100 years, and we're about to hit that target for that grand supercycle here, which completes this wave 5, this wave 5, and this wave 3. Okay, guys, so that's the grim prediction now. So, with that being said, let's drill into the market, understanding that we're in this wave 5 off of the 2020 COVID lows. Okay, we're in this wave 5 off of the 2008-2009 crash, and we are completing this grand supercycle 3 off of the bottom of the Great Depression. Okay guys, so here we are zoomed into the last leg up here to supercycle 3, and this is off of the 2020 COVID lows over here in March that we're building our 5-wave structure up to complete this wave 5, and the grand supercycle 3 up around 6,000 on the SPX. Some people have asked me how I got to the target of 6,000, and I don't think I said it earlier in the video, and I probably should have. We don't just put in waves because they fit. There are several rules of Elliott Wave that must be followed, including mathematical levels based on Fibonacci numbers that must be met in order for it to be a qualifying wave. Now again, this is not an Elliott Wave training video. It's more of a big picture overview, so I'm not going to dig too deep into that, but we are going to cover a couple things of how I got to this 6,000 target. So if we come over here and grab our trend-based fib extension tool, and we come to the bottom of wave 4 right here, right there, to the top of wave 1 right there, and then down and 2 and across, so we can see we get to the bottom of wave 2. All right, our 236272 level, which is where wave 3s are expected to hit most often, come in right around 5,000, and then we pull back in wave 4, and then wave 5 is going to hit the 2.0 extension. Now, most commonly, wave 5s hit the 1618 extension of waves 1 and 2. However, there are a few factors here that are a little different that I'm going to discuss now that lead me to believe we will hit the 2.0 or greater extension. The first is this wave 4 came down a little lower than we thought and broke through the channel trend line. Now, when that happens, Elliott called that a throw under. And typically what that means is wave 5 will be a throw over, meaning it will go a little higher than it's supposed to. On the second part of that is we are hitting the end of a grand supercycle wave. And what drives Elliott Wave Theory is sentiment, which means fear and greed. And what will happen is, or at least what I believe will happen is, as we drive up in wave 5 here, greed will take over and you will get a bit of a blow off top, so it will blow through the 1681 extension. You're going to get that throw over, plus you're going to get a little bit of greed takeover until it blows off the top here at about the 2.0 extension, where I think it's going to be about 6,000 on the SPX. So once that happens, as I said, we are expecting a severe crash at that point. If you want to see this in a more accelerated version, go check out Bitcoin's run from 5,000 up to 20,000. Okay, it turns parabolic, and then once it blows off its top at 20,000 the first time it gets there, it pulls back to 5,000 again, losing 3/4 of its value. I believe we will do the same here, just not as accelerated as Bitcoin did it. So this 6,000 area is going to be where I start to pay attention to pullbacks, breaking of support levels, things like that. Could it push up higher than the 6,000? Absolutely. Could it miss the 6,000? Absolutely. Nothing is perfect and nothing is guaranteed in the stock market. If it was, we'd all be rich and it'd all be easy, right? So take it for what it's worth to you. This is one humble man's opinion of where the market is heading in the next several years based on Elliott Wave hitting target after target and proving itself over and over again to me. Guys, if you enjoyed this video and you want to hear more from me on the stock market, you need to get in my Facebook group. There's a link down below. Go ahead and click that link. You'll find in there a link to a Slack channel, which is just a free chat group. We have a bunch of guys in there. I tell you real-time market updates. I tell you when we are trading, what we're trading exactly, when we're buying it, what we're selling it, the levels we're buying, all of that good stuff. We'd love to have you in there. It's a great group of guys. The only requirement, guys, the only thing you got to do is subscribe to this YouTube channel. All right, so hit that subscribe button down below. Get in our community. We would love to have you.